Hello, class, and welcome to Chapter 8. Chapter 8 is or marks the point where we're sort of moving into a different direction for managerial accounting. And the chapter is based on a budget. Okay, we're going to do the master budget, and then the next couple chapters, we're going to talk more about the manufacturing process and um, doing budget variance type analysis. The master budget will take into account some of the things that we've learned as far as the production cost and cost of goods sold, et cetera. But the master budget is something that companies usually do once a year, every year. And it's a difficult process. It's very time consuming. It takes a lot of resources. And what you're trying to do is basically predict the future. And since most companies start, let's say that your fiscal year runs from January to December, most companies will start in July and will start the budgeting process. So, really, you're looking to predict the future 12 to 18 months out. Now, take into account what happened in COVID, and you can see that the budgeting process can be very difficult, and a lot of budgets can be just useless by the time you get around to actually, producing the products and selling, etc. Budgets sometimes are they're not fair. You're given expectations that you just simply can't meet. I've been in that situation before, and I was told go ahead and budget, even though realistically there's no way I was ever going to achieve that. But so there are some politics that go into budgeting. Um, and everybody wants to hit their budget. So a lot of sandbagging goes on. That's called, underreporting. So you don't really stretch yourself to hit the revenue or the cost reduction goals that maybe you should. But that's human nature. Everybody likes to go in on the monthly call and say, "Hey, how did you do the budget?" And you're going, "Hey, we exceeded budget. We hit our targets." Nobody likes that conversation where you're continuously behind and have to explain what you're going to do to correct the situation. But I've found that what you really need to do is to have answers, solutions. And we'll cover that really in the next couple of chapters. And those chapters will help you uh, answer some of those questions. All right, so a budget is a detailed quantitative plan for acquiring and using financial and other resources. It usually covers a year. Some companies also use a perpetual budget, which is a 12-month budget that continuously rolls forward. So, in other words, at the end of January, now you're going to budget from February through the next January. So, you continually change the budget. It's probably a lot less work at one point, but it's something that you have to do every month. And it's probably actually better for a company, although that means that not only do you have to do all that you're supposed to do, you have to continually update the budget. Operating budgets normally are just cover a year. A continuous budget, again, just continues to roll forward. Many companies do divide their annual budget into 4 quarters. A lot of that has to do with being a public company, and public companies have to produce quarterly financial statements. Two keys are planning. Okay, so it is good to plan to go, okay, if I need to increase revenue by 10%, what do I need to do? And then control involves the fact that every month you're held accountable for your numbers. And so you will have a variance report. Did you hit your revenue? If you're responsible for revenue, did you hit your number of units that you were supposed to produce? Did you produce those units at the cost that we expected you to do it? It does get you to think about the future because a lot of times, you're into the weeds of things and you're in the day to day, and sometimes you don't always get to have time to think about the future. And this forces you to think about the future. How many people are you going to need? Um, do you need to replace some of your assets? If you have trucks, are you going to need to replace some of the trucks? Are they getting old and now have a lot more maintenance issues? And these are the questions that you ask during the budgeting process. So you're planning for the future. From the control standpoint, you use it to improve efficiency. You can compare yourself to other companies. How come it takes us more resources to provide the same level of service? And then you evaluate and reward employees. And a lot of times your bonuses are based on budgets. So there were a couple of things. There's a self-imposed budget, which means basically top down, or I'm sorry, a self-imposed or participative budget means that you start from the bottom up. Honestly, I don't know any companies that do that. You may start from the bottom up, but then you roll it all up and manage it goes, well, this isn't enough. All right. So when managers throughout the organization work collaboratively to prepare a budget, they often strive to establish challenging targets that are also highly achievable. These goals are likely to build a lower level manager's confidence and commitment to the budget. So again, if you start at the bottom and move up, you have more buy-in. But top management has goals that they want to achieve. They may want a 10% increase in net income. The advantage of self-proposed, it shows respect for their opinions. It could be more accurate because they are the frontline managers. They know what's going on. Motivation is generally higher. They have buy-in to these budgets, whereas the one budget I referred to, I knew I was never going to make it, so I had to sell it to my employees, but I didn't have buy-in, and it empowers you to take ownership. If I come up with a budget, I've taken ownership. It's my goal to achieve that. Budgetary slack is called, again, sandbagging. That's just human nature. You want to hit your targets. Nobody likes an unpleasant conversation when you go in there and go, how come you're always off your budget? Now, there are different types of budgets depending upon where you are, but every budget stems from the sales budget. What do we expect to sell next year, next quarter, the following quarter, etc.? And that is driven really by capacity. If you have a Chick-fil-A, again, if you have two drive-through windows, you're going to be able to have more sales than a Chick-fil-A with only one drive-through window. You can't say, well, I expect you to achieve the same success from a two drive-through window, but you don't have that capacity. Long term, what you do is you will determine what capacity you want. But everything starts with a sales budget. It determines the production budget, and that production budget, of course, will determine direct materials, direct labor, manufacturing overhead, and all of that will tell you how much cash you're going to need, how much you're going to collect, how much you're going to spend, how much you're going to need. And then you'll come up with a budgeted income statement and a budgeted balance sheet. And if you're a public company, that goes to the board of directors, and the board of directors will sign off on that. Seeing the big picture, there are 10 schedules that, according to this author, you need to come up with and questions you need to answer. How much sales revenue? How much cash we will collect? How much raw material we need? What are the manufacturing costs? How much cash we're going to have to pay for our suppliers and laborers? What's the total cost that'll be transferred from finished goods to cost of goods sold? How much SG&A expense will we incur? How much do we need to borrow? Because if you're a company that has most of their sales in the winter or in around Christmas time, you're going to want to stock up, and so that you don't lose sales. And so you borrow money through the season, which you pay back in January. What will your operating income be, and what's your balance sheet going to look like? All right. So it's based on estimates and assumptions. And again, the first thing is budgeted unit sales. How much are we going to sell? Depending on how much we sell will depend on how much we need to produce, which is also dependent upon what our beginning inventory is and what our ending inventory is. Um, how much are we going to charge each unit? And then how much are we going to collect in our accounts receivable? A lot of companies use Microsoft Excel, but it's difficult with Microsoft Excel because there are formulas that if you change something, it can really make or introduce errors unknowingly, and also it's sometimes hard to change. So we're going to prepare a sales budget. Royal Company is preparing budgets for the quarter ending June 30th. So for the next 5 months, we believe these are going to be our sales. So May is obviously a good month. August, not so much. So the selling price is going to be $10 per unit. So it's just the number of sales times the sales price per unit. So here is the revenue we expect to produce for the 3 months and for the quarter. Cash. Now we don't normally. Okay, so this company will provide credit to their vendors or to their customers, and so the customers normally pay 70% on the month of sale and 30% from the prior month. So this month we're going to get 30% of the sales from the prior month and 70% of the sales from the current month. And so in April, the March 31st accounts receivable balance of 30,000 will be collected in full in April. Well, you hope so, but sometimes there's bad debt. So we start with the cash and we collect 30,000, and then we're going to add 70% of May sales or April sales that we'll collect in April. And then we'll add 30% of April sales plus 70% of May sales. That'll be collections. And then June will be 30% of May sales plus 70% of June sales. And you can see that here. So really it's just math, okay? But you have to come up with the 70% and the 30%. You have to come up with the sales budget, etc. So here is the budget for that. What will the total cash collections be for the quarter? So it would be this amount plus this amount plus that amount. So let's see. Well, we didn't put in here 30% of that plus where's June's numbers? So it's going to be 940. All right. So we put in June's numbers and that gives us that total. So again, it's just kids down to math. And then we talk the production budget, which is again dependent upon how many we expect to sell. And the other factors, what do we have on inventory at the end of the period? And then what do we want to have on inventory at the end of the period that we need to sell in the following month or following quarters? So your production budget is going to be how many units do we want to sell? Add in how much inventory we want to have on hand, and then subtract, well, how much inventory did we start with? The management wants ending inventory to be equal to 20% of the following month's budgeted sales. We start the quarter or the month with 4,000 units on hand, and so we're going to, in April, let's put that, so on March 1st, we had 4,000 units. And we expect to sell 20,000 units at the end of, or in the month of April. And we want to have 20% of this number in our inventory. So we want to have 20,000 plus 20% of this, which would be 20,000. So we want to have 40,000 units available. We started with 4,000 units, so we want to produce 36,000 units, if my math is correct. 20% of that. I used 40%. So my math wasn't incorrect, but you see how it's done. And then you just keep doing that. Okay. So here our beginning inventory is going to be the desired ending inventory. All right. So here, 50,000 plus 20% of this. So that would be 6,000. So we need 56,000 units. And we're going to start with 10,000. So we need in this month, if my math is correct, 46,000. That's correct. And you just keep doing that, same thing to the end. And so then June, you'll need to know what you expect to sell in July. So based on this production, we are going to have direct materials and we're going to have direct labor and we're going to have factory overhead. Again, we will estimate the factory overhead so that we can allocate it. So materials used per pound, and with just, again, it's simply math, production needs, but the same thing is that desired inventory. So we want to have 10% of that amount on hand here. And so we're going to need 153. We start with 13. We're going to be 140. So here we're going to go, okay, so we want to produce 46,000 times 5. And we want to have an additional 10% of this. So that's 14,500. So 14,500 plus 230 minus beginning inventory, which is 23,000, and that should give us the result. Let's go back here. So 230,000. And we're going to add in the 10% of the 145, so that's 14,500 plus, and we're going to subtract out the ending inventory, which is 23,000. So if my math is correct, it's 221,500. All right. So again, same thing. What do you need to sell this month? What do you need to have on at the end of next month? You add those together and you subtract what you have on already, and that's going to give you the result. And we just carry that on through. Same thing with this other material. Like I said, you just need to know the formula, but it's just fairly simple math. Expected cash disbursement. Okay, so what is our disbursement? Okay, so one half of month's purchases is paid for the month of purchase, the other half is paid the following month. So then we will pay the 12,000 in May, and then we're going to need 56,000 in April. So we paid that. So in May, we're going to pay out 50, the other half. And so we're going to then add in whatever we pay out in May, half of that, to these 28,000, and that's going to give us. All right. So how much do we need? Let's go 185. All right. So basically, I didn't want to look that up, but May purchases were 88,600. So again, half then we could pay half in that month, half in the following month. And so that's really how you do the cash for that. And then the direct labor budget, again, will depend upon the production budget, which is dependent upon the sales budget. And so we go through the same process. What is our production budget? So we have that, we multiply that by the direct labor per unit, and then we multiply that by the wage rate. And so this is going to be what we'll pay for direct labor. What would the total direct labor cost for the quarter be if the company pays time and a half for hours worked by employees over 2,000 per month? Well, okay, it would be this much plus 300 times 15. So that should be another 4,500. So that should be 55,000 if well, I don't, that can't be right. All right, for anything over 2,000, so that's 300, and we pay time and a half, so 300. Okay, 4,500 plus 50. Hmm. Let's see what their calculation is. Regular 47 times 10, 5,050 hours. Okay, I see what I did. I double counted this. So really, it should be 300 times the extra $5. So that's 1,500. So that's where they get the 52,000. My mistake. It's easy to make in accounting, so you need to check. So a manufacturing budget overhead, again, we have variable manufacturing overhead rate is $20 per direct labor hours, which we just figured out. Manufacturing overhead is 50,000 per month, which includes 20,000 non-cash costs, which is depreciation. So let's prepare that. So we have the budgeted direct labor hours, and then we're going to multiply that by 20. So the manufacturing overhead for the quarter is going to be 251. Total labor hours are 5,050. So we're going to allocate manufacturing overhead at 49.70 per hour. And because depreciation is non-cash charge, does it say how fixed is 50? It doesn't say how we pay these, but to do the finished goods inventory budget, which is direct materials, direct labor, and manufacturing overhead. So ending inventory in units, production cost is $499. And so we want to have 5,000 units in inventory. It costs us $4.99 to make. So our ending finished inventory is going to be 24,950. And then we prepare selling and administrative. Again, based on the sales. So the variable cost is 50 per unit. So however many units we expect to sell times 50. And then there's a fixed cost of 70,000 per month. So that's going to be 70,000 times 3 is 210,000. And that includes 10,000 of depreciation. So our cash cost is really going to be 60 times 3, 180,000 plus 0.5 times the number of units that we sell. Calculate the selling and administrative cash expenses for the quarter. Um, so it says, oh, for the quarter. So let's look at budgeted sales times the variable rate is going to be $50,000. Fixed cost of $210,000 is 260, less $30,000 of non-cash expenses is equal to cash expense of $230,000. And then we're going to prepare the cash budget, which is, of course, looking at all the cash receipts, which we figured out based on the sales, cash disbursements, which we added based on how we pay our vendors, how we pay our employees, how we pay for the overhead. And then we have to figure out, well, what are we going to have enough cash? As a company, we have a credit line with a bank or some institution. We want to maintain a minimum cash balance of $30,000. We're going to pay a dividend of 49,000 in April. And so all of this really is just you plug it in, okay? And so that's really where the difficulty is you just need to know where to plug the stuff in. But the same thing, we're going to go and put in all those schedules. And really the accounting staff is going to do this. And they'll do it for the month, and then we're going to determine that we are going to have 130,500 in cash available. And so then we're going to pay back the amount that we borrowed. So you just need to plug it in. You just need to schedule, and then we're going to budget the income statement based on all of this. So we have sales of 1 million. We have cost of goods sold because we're going to sell 100,000 units and we expect it to cost us $4.99 per unit. So our gross margin is 501. We've calculated this based on this budget, and so we expect our net income to be $239,080. And so the trial balance, again, the accounting staff is going to do this, and what you will do is factor in, changes in in any of these. Are we going to add equipment? We have 248,650 in retained earnings. We'll add the figure for retained earnings that we keep, which will be income less the dividends that we pay. And again, assets equal liabilities plus owner's equity. So this 617,130 has to equal this 617,130. And you just prepare that. So a lot of it is just where to plug in the figures. And you start out with the sales budget. And so when you make changes, that's where, and you always make changes. You're never going to do the budget the first time and everybody goes, hey, this is great, and we're done. And so that's where every time you change the sales budget, then you've got to change the production budget, and you've got to change the raw materials budget, and then you've got to change the um, direct labor budget and the overhead budget, SG&A budget. And so that's where all of the extra time comes in. And so it is an involved process. And if you're ever in management, this is something that you're just going to have to live with and do. And then also every month you'll have to sit there with your managers and go, how did we do?